Hello, I'm Russ Mould, AJ Bell's Investment Director, and welcome to Fundamentals, our regular look at the world of funds and collectives, where we highlight one of the most popular purchases on the AJ Bell Invest Centre platform and then analyse why advisors and clients might be buying right now. This week, at the very top of the list for passively run funds is ETF Securities ETFS WTI Crude Oil ETC, or Exchange Traded Commodity. The instrument is designed to enable clients to gain an exposure to a total return investment in crude oil. Now, this all sounds simple enough, but it's very important to understand how the ETC works. And note, this is an ETC, Exchange Traded Commodity, not an ETF or Exchange Traded Fund. Under European UCITS rules, an ETF must invest across a basket of at least 5 securities. An ETC is permitted to track just one. Now, in this instance, the ETC provides exposure to oil by tracking the Bloomberg Crude Oil Sub-Index. This benchmark contains a basket of crude oil futures prices based on West Texas Intermediate, WTI, the American equivalent of European Brent crude. Note, the ETC doesn't physically own any oil, as that frankly storing the stuff is expensive and that erodes returns. The ETC tracks futures prices and therefore uses indirect or synthetic replication to generate performance via a fully funded collateralized swap with its counterparties, who are in this case UBS and Merrill Lynch. Now, the total return obtained by a client from the instrument comes from 3 sources. First, the underlying changes in the oil basket's price. Second, the roll yield. Now, the client won't want to receive the oil promised by the futures contracts, so when they're about to expire, the futures are rolled over into new agreements. If oil is in contango, the futures price is above the spot price, the roll yield is negative as the client sells out of lower prices and buy at higher ones. If the oil price is in backwardation, the futures price is below the spot price, then the roll yield is positive and adds to performance as the client effectively sells at higher prices, buys back in at lower ones and gets more oil per dollar. Third, the collateral yield. Investors in commodity futures must set aside collateral, and this generates interest income, which is then reflected in the futures price. So of those 3, movement in price, roll yield, collateral yield, the first 2 are by far the most important. But the point I'm making is that when a client buys an oil ETC, they're not just getting changes in the spot or current delivery price. Also note, this particular ETC is not currency hedged, so changes in the dollar against the pound could also enhance or worsen performance. For all those technicalities, what buyers of ETFS WTI crude oil are looking for is direct exposure to movements in oil. This does at least eliminate any risk associated with stock picking or even finding a fund with a substantial weighting in oil producers. The ETC also comes with a total expense ratio of just 0.49%. So that's the mechanics. Next question, why would advisors and clients be thinking of buying the ETC right now? Well, someone somewhere clearly believes oil prices are due a rebound at some stage. So WTI has plunged from its 2013 high of $110 a barrel to around 30. Now, why might it rebound? Well, I can think of 3 reasons pretty quickly. First, many oil-producing nations need higher oil prices to balance their budgets. Russia, Saudi Arabia and Venezuela are among them. That may explain last week's agreement in Qatar to freeze production and try to impose some supply-side discipline. This graphic here shows the oil price needed for a balanced budget at leading exporters according to the International Monetary Fund. Second, low oil prices are forcing oil drillers to cut back on capex and exploration work. The worldwide Baker Hughes active rig count of just under 1,900 is the lowest number since 2002 as firms like BP, ExxonMobil and Shell reduce spending. This could help check output growth in the long term. And third, oil is becoming increasingly hard and expensive to find and extract safely, as new finds tend to be in deeper water and less hospitable areas. Add this to drilling cutbacks and oil firms are already finding less oil than they're pumping. In 2015, BP replaced just 61% of the oil it produced with new finds, while Shell's total reserves shrank owing to a reserve replacement ratio of -20%. Okay, so that's the potential good news. The bad? Well, these supply-side effects could take a long time to work through. In addition, the removal of sanctions is bringing Iranian supply back into play. Iraq also wants to sell more oil and Libya's desperate for cash. They don't seem too fussed yet about supply-side discipline, just raking in dollars. In the very long term, wind, solar and renewables are also threats. potential alternative sources of energy that could challenge fossil fuels' current predominance. More immediately, US oil inventories stand at around 500 million barrels after a mild winter, highest figure since, well, certainly since I can find data, and there's no shortage of crude, therefore, in storage if demand suddenly does accelerate. The geopolitical angle to oil also makes predicting its future price movements very, very difficult. Saudi Arabia's motives for having pumped up oil production in the first place remain unclear. It's possible Riyadh wishes to damage the US shale industry, while its Sunni Muslim regime appears to have no love for Shia Iran, whose return to the international market will also potentially be seen as an unwelcome development. It certainly seems likely that oil is going to remain volatile, so it'll be fascinating to see which of all of these trends prevails in the coming weeks and months. So thank you for watching, and I look forward to seeing you next time.